Now, what is measure of recovery? This is what something you even there was another student. I'm sorry, I didn't quite catch your name. Just before this, you were talking about recovery. So here we are going to learn about measure of recovery. So measure of recovery of claim is an insurance policy that would be proportionate to the insurable interest and the loss or damage that is caused vis-a-vis the coverage contracted in a valid insurance policy contract. So therefore, what is the measure of recovery of claim in an insurance policy? So they say that the measure of recovery should be proportionate to the insurable interest and the loss or damage that is caused. So what can be recovered from a claim should be equivalent to the loss or damage that is caused vis-a-vis the coverage that is contracted in a valid insurance policy contract. Now, what are the factors to be considered in measuring recovery? One is the loss or damage would be ascertained or evaluated based on the valuation of the property that is damaged in case of property insurance or automobile insurance or even fire insurance. Now, what happens in fire insurance? The value of certain goods would be, they would evaluate the value of certain goods that would be at the time of loss, that is deducting depreciated value. Thus, current value will be ascertained and accordingly the claim amount would be calculated. So depreciation would be considered to calculate the final claim amount for disbursal. What is depreciation? Like, as you know, like in commerce, we study that any assets for that matter, they depreciate over the passage of time. Like the value of a particular good is different while it is new, and the value depreciates as the years pass by. Likewise, the value of a particular property or a house, I'm not talking about lands, okay? Lands may increase. I'm not talking about that. I'm talking about house, the structure. It will depreciate. The value will depreciate because of the materials that are there. There is wear and tear. It gets worn out and so on. So the value depreciates. So therefore, when measuring or calculating recovery, the depreciation would be considered to calculate the final claim amount for dispersal. Next is current market value is also a factor that would be deliberated or calculated as a tool for measuring recovery. So what would it be? Of course, it would be the extent of loss or damage. Next is the value of the goods at the time of loss, the current market value, as well as depreciation would be considered. The factor of the usefulness of the destroyed and insured product, this property, also known as obsolescence, would be measured. That is, how useful is a particular product or a property that has been destroyed. The factor of co-insurance, if necessary, especially in health insurance, even that would be considered. In case of more than one insurer, payment of claim would be disbursed on a pro rata basis. That means it would be distributed equally if there is more than one insurer. Next is self-induced or destruction of property with the intention of fraud or earning out of insurance claim also would be considered. Why? If there is a self-induced destruction, then they would not honor that particular claim, as we discussed during the last class. What did I say during the last class? In case there is fraud and a person deliberately does something, then it would not be considered for honoring any claims, or the insurance company would reject such claims. So self-induced, whether at all. So why we are talking about it here? We are talking about how recovery is measured. That is how claims are measured. So self-induced destruction of property will not be considered. Obviously, if it has the intention of fraud or earning out of the insurance claim. Next is due consideration may be given to appraisal clauses and arbitration clauses, if any, in the insurance contract. This arbitration clause, what is arbitration? It's just like the court, but it's not a court. It is a distinct or a different dispute redressal mechanism. I'm not sure whether you have studied the law of arbitration or you're going to study law of arbitration. I do not know the next semester, or you already studying. I'm not quite sure of that. But well, arbitration is a dispute redressal mechanism apart from the courts. You call it arbitration, then you have mediation. So arbitration clause, they would see whether at all adjudication of disputes or resolution of disputes, or in simple terms, in layman's language, if we have to talk about solving the problems between the parties, instead of approaching the courts of law, they prefer referring it um, to an arbitrator, which comes, and they would use the principles of law, that is, principles of arbitration there. I mean, that's a different, entirely a different subject. I would not go deep into that now, but just normally there can be a clause in an insurance contract, and they would say that, well, we want to resolve the matter by arbitration, and they would decide, just for your understanding, like how many arbitrators would be there, like one or two. So if the parties say no, one arbitrator, okay, so one arbitrator, and the language of arbitration would be English, and the place of arbitration, say for example, would be in Paris. Example, in Paris normally, like Paris, Singapore, London, these are the places normally people prefer. Not that their own countries do not have arbitration, they do have arbitration, but I'm talking of about cross-border arbitration. But in case it is insurance and it is within the jurisdiction or within a particular country, and they say, well, we would solve the matter by arbitration, then they would say, okay, then there would be a particular, body that takes care of arbitration, and there would be arbitration courts, and they would say that, well, so, let us resolve the matter by arbitration rather than referring the matter to the normal courts around. So they would see whether there is an arbitration clause in an insurance contract where an arbitrator is appointed, and the dispute may be referred to arbitration because arbitration is comparatively faster and more convenient, but it cannot be denied that it is more expensive than the normal courts. Next is insurer's right and the duty to defend. Now, the insurance company or the insurer is under a duty to defend the policyholder against third-party suits which are instituted against the policyholder, where the subject matter of the insurance comes under litigation. Now, here the question is not about what and who is right or wrong. So, invariably, when the insured or the policyholder faces a legal battle regarding the subject matter or proposed subject matter covered under a valid insurance policy, the insurer is customarily obligated to defend the insured. Now, there is this four-corner rule also, you can call it as an eight-corner rule. Now, here it says to determine whether the insurer is obliged to defend the insured in third-party litigation, the pages and the clauses of the insurance contract need to be meticulously read or carefully read. So within the parameters or the presence of insurance, the contract is the answer to the question of whether the insurer is required to defend the insured. So this is also called as a four-corner rule or even the eight-corner rule of insurance. That is, within the parameters of the insurance contract, the answer to the question whether the insurer is required to defend the insured. Now, ambiguous claims or remote claims and litigation beyond the ambit or the purview of subject matter of insurance cannot compel the insurer to participate and defend the policyholder. So the implication here of the insurer exercising the duty to defend the insured and the insured's right to be defended to the extent of the subject matter of the policy that is insured under a valid insurance policy. What are what is the criteria? What are the things that they would consider? One is, should the court decree in favor of the third party and the decree be executed, then the insurance company will be expected to pay the entire amount under the policy contract to which the insured is legitimately entitled under the specific insurance scheme. So consequently, nothing remains or something or very little remains partially to be disbursed or released to the policyholder. Next is, if the insurer or the insurance company has already satisfied the claim prior to the litigation, prior to the dispute, then what happens? And the insurance company certainly will not be made a party to the litigation under an expired insurance contract. Why? Because the insurance contract itself is, it has expired, and he has already or the insurance company has already disbursed the amount to the claimant. Next is, in case the insurance company fails to defend such litigation during the subsistence of a valid insurance contract, then the court would make the insurance company liable for any additional costs borne by the policyholder in that regard, such as attorney fees, such as the lawyer's fees, etc. So the court may also extend damages to the insured for the mental agony suffered by the insured for the insurer's breach of duty towards the insured. Next is for breach of duty or even negligence of the insurance company in exercising its duty in this context, the courts may impose pecuniary or financial damages or monetary damages that may even exceed the cost or the value of the policy. Now, the insurer or the insurance company may protect itself against such an allegation of failure to defend by a provision to that effect in the insurance contract under a waiver clause, or execute a rider, that is additional document that may be appended to the insurance contract on the waiver. So in the alternative, the insurer can even seek a precautionary step by way of a declaratory judgment action against the insured, that is a policyholder, and determine the coverage of the policy, etc., in the pursuit of safeguarding against any future claims that may exceed the policy limit, apprehensive of a failure to defend in case of being impleaded as a party to a third-party litigation in which the subject matter of the policy is made part of it. So the third option before the insurer is to issue a reservation of rights letter instead of or in lieu of a waiver document with the intention of informing the insured or the policyholder of not intending to participate in such external claims, but instead encouraging the policyholder to seek the advice of a lawyer in that direction should such a need or a situation arise. The next is an interesting principle of reinsurance, which is important examination point of view. Reinsurance mostly can come in the form of short notes, maybe. So what is reinsurance? Now, this is basically a situation or an arrangement where the insurer becomes the insured. I'm repeating. Who is the insurer? The insurance company. Who is the insured? The party who is buying the insurance policy. So what we're talking about reinsurance, when we're talking about reinsurance, what we're talking here is the insurer becomes the insured by transferring partly or wholly risks that it has undertaken to cover in certain circumstances to another insurance company or the insurer by executing a valid reinsurance contract, and thus would be referred to as reinsured. It's also called a stop loss insurance. Why? Because it helps to avoid carry a heavy load of risks upon a particular insurance company, and they try to share it with another insurance company. So now, practically speaking, it simply means that where one insurance company tries to insure a particular claim or a group of claims with another insurance company. So this is reinsurance. So this is a kind of a legitimate arrangement where they execute a valid contract for consideration of its premium, and then it's called as a reinsurance contract. So the backing of another insurance company is normally sought by an insurance company here when it is unable to manage the load of risk and the financial coverage of those particular risks, or pecuniarily they are not able to cover those risks. So that is, financially they're not able to cover those risks. So the subject matter of the reinsurance contract here is insurance liability. So there's this case of Union Central Life Insurance Company versus Lowe. The court held that this involves a principle of indemnity. What is indemnity? It's a very important principle in insurance law, that is to make good the loss. This is one of the important principles. I remember I've taught you, I think, during the second class. So this concept is distinct or different from co-insurance or multiple insurances sought by the insured. Reinsurance is the insurance policy cover which is obtained by insurance companies. So normally it is, a coverage or insurance policy coverage for insurance companies, for and by. So in Bethke versus Cosmopolitan Life Insurance Company, the court observed here that the reinsurance is a contract where one insurer makes with another to protect the first insurer from the risk already assumed. So the company getting the risk reinsured is called the ceding company. And the amount of risk retained by the ceding company is called retention. Let me repeat this. The insurance company getting the risk reinsured is called the ceding company. And the amount of risk that is retained by the ceding company is called retention. The amount of value reinsured is called cession. So the reinsuring company may further want to reinsure the risks that it has contracted to reinsure, and that is called as retrocession. I'm repeating this again for you. The reinsurance company may further want to reinsure the risks. Already there is reinsuring. So the reinsuring company, again, the insurance company which has taken over the risks of another insurance company. So the insurance company which has taken the risk of another insurance company under the contract of reinsurance. So that company also may want to reinsure the risk that it has contracted to reinsure. So that is called retrocession. Again, I'll repeat it for you. Company A is an insurance company. Company B is another insurance company. Company A is telling company B, please, I've got a lot of risks that needs to be covered. I'm not able to handle it. Please, I want you to insure it for me. So company B takes over some of the risks. So company A is called the ceding company. Some of the risk that it retains, it's called retention. The amount of value it is trying to reinsure is called as cession. So company B takes over cession. It takes over some of the value. It agrees. So the company that is reinsuring is company B. The company that is reinsured is company A. Now, company B is the reinsuring company. The company B feels heavy. It has got its own burdens. So company B says, oh, company C, won't you help me with my burden? So company B is a insurance company. Okay. And okay, Mohammed, no problem. So company B is a reinsurance company. So that may want to further reinsure the risk with C. So that is called retrocession. Okay. So the general principle, the contract is between the direct insurer and the reinsurer. So it is the direct insurer who will be made liable to the direct insured and not the reinsurer. So there is no contract that exists between the insured and the reinsurer. The contract here is between the reinsurer and the reinsured, the ceding company. Thereby, the benefit of reinsurance that comes to the fore is a risk is spread and the risk is transferred. So that is a benefit of reinsurance. So broadly, reinsurance can be dichotomized as treaty insurance and facultative insurance. So this dichotomy will help us to understand the method that is used to cover the risks, whether proportional or non-proportional. So treaty reinsurance is a pre-arranged arrangement whereby the direct insurer cedes and the reinsurer accepts cessions within predetermined limit insurance. So it is mandatory to accept risks under this method. Thereby, there is a treaty or an agreement drawn between two or more insurance companies whereby one agrees to cede its risk, that is direct insurer, and the other company or the company's reinsurers agree to accept reinsurance as per conditions specified in the treaty. So there are different types of treaty insurance. However, the most common forms are quota share, QS, also called as proportional, because here a proportion is ceded where the reinsurers take a specific share proportional risk or obligation to pay claims in each policy, and it's directly proportional to the premium of reinsurance. So here original risk is sought to be shared. Next is surplus excess of loss. Here direct insurer reinsures only the surplus amount after its retention, and the reinsurers are inclined to accept such cessions. Next is XOL or excess of loss ratio or stop loss. Here, the relationship or the nexus between gross premium and gross claim over a year is examined, based on which gross loss is determined, and the ceding company decides a ratio of gross loss up to which it can sustain. Next is combination strategy, that is a combination of QS and XOL. That's just a combination strategy. It uses the principles of both, that is quota share, that is where a proportion is ceded along with excess of loss ratio. Next is pools. Pools are basically treaties between companies where members join hands to share premiums as well as claims. So this form is normally used to cover risks or insurance policy of hazardous business. Next is non-proportional. Here, the reinsurers are not proportionately liable for the loss. Likewise, premiums also are not proportionally shared with the reinsurers, which means the losses covered may be in excess of the value of insurance cover. So the loss is reinsured in the non-proportional method. So this is all about reinsurance. Next is facultative reinsurance, of course, apart from treaty insurance. So under treaty insurance, we have uh, 6 type of treaty insurance, that is quota share, surplus, excess of loss, combination strategy, pools, and non-proportional. And next is facultative. That's nothing but it's used in simple business covers. It's not complex. And where risks are optionally reinsured and is handled on a case-to-case basis, where the cedent passes a single or a block risk on a one-off basis. It is distinct from treaty reinsurance to the extent that a separate reinsurance policy is contracted for each risk. So this method is undoubtedly flexible or indubitably flexible and tailored to meet the needs of the reinsurance. So it may be further classified into pro rata and excess of loss. So thereby we have treaty reinsurance, under which we have 6 types of treaty reinsurance, and next is facultative reinsurance, under which we have 2 types, that is pro rata and excess of loss. So reinsurance basically is where one insurance company tries to cover the risks and the losses of another insurance company by way of an insurance contract, and such a contract is called a reinsurance contract. The company that is getting the risk reinsured is called the ceding company, and the risk that is retained by the ceding company is called retention, and the amount of the value that is reinsured is called cession. Well, in fact, if you just go a little bit further, the reinsurance company may want to again reinsure the risk, and that is called as retrocession. So let me know if you have any questions. So this is all, and with this we complete our syllabus. So these are all short chapters from 8 to 10. They're all small chapters, and on this you can just expect short notes. Okay, let me know if you have questions.